Welcome to the Maybe Not So Great Books channel. You decide. Today, The Intelligent Investor, the definitive book on value investing by Benjamin Graham, the Bible of value investing written by a man whose greatest win broke every rule in it. But is it actually good?
Welcome to the debate. And wow, that is certainly a provocative way to open a discussion on what is basically the holy grail of financial literature.
I try my best.
You really do. I mean, we are talking about a text that billionaire investors just hand out like candy, right? Warren Buffett calls it, quote, by far the best book on investing ever written. But I will concede the premise of our session today. There is a massive tension between the legend of Benjamin Graham and the actual utility of the text in 2026. So is this book a practical manual for wealth preservation, or is it a museum piece that we keep on the shelf just out of respect for tradition?
That is exactly the central question here. And honestly, I want to strip away the reverence right now. We treat this book like scripture. But if we look at it with cold, hard rationality, which is, what Graham would want, the specific methods in this book are operationally dead.
Dead? That's a strong word.
Yes, operationally dead. The author's track record is widely misunderstood, and the text promises a system of active stock picking that Graham himself eventually repudiated. I mean, if a listener follows the rules in this book to the letter in today's market, they will not get rich. They will likely just sit in cash for a decade, or worse, buy value traps that go to absolute zero.
I think you are conflating the tools with the architecture. Yes, the specific formulas from the 1970s are dated, but if you strip away the math, what remains is the only psychological framework that has ever successfully prevented investors from destroying their own wealth. The math is dated, sure, but the psychology is immortal. We are talking about the difference between being smart, knowing how to calculate a ratio, and being wise, which is knowing how to behave when the market collapses.
We really need to scrutinize that wisdom, though, because the mythology of Benjamin Graham is doing a whole lot of heavy lifting here. The standard narrative is that he was the dean of Wall Street, right? A man of steady, safe, conservative value investing. Margin of safety is his whole motto. But his own biography contradicts that story in violent ways. You really can't separate the text from the trauma that created it.
You are referring to the Great Crash of 1929.
I am. The book preaches safety, it preaches defensive investing, but the man who wrote it entered 1929 with 44% margin debt.
Right.
He was leveraged to the hilt. His fund, the Benjamin Graham Joint Account, lost 70% of its value between 1929 and 1932. This wasn't just standard market volatility. This was a near total wipeout. His wife actually had to go back to work as a dance teacher just to pay the bills. So when we read The Intelligent Investor, we aren't reading the cool, detached wisdom of a sage in an ivory tower. We are reading the scar tissue of a man who got absolutely crushed by the market.
I don't disagree with the history, but I completely disagree with your conclusion there. You say the crash disqualifies his advice. I say it validates it. The Intelligent Investor wasn't written before he learned those lessons. It was written because of them. The trauma of 1929 is exactly why he created the distinction between investment and speculation. He wasn't writing theoretical papers. He was writing a survival guide from the battlefield. He was trying to build a system so that no one, including himself, would ever suffer that kind of loss again.
But does the system actually work? Let's look at his biggest win. The one trade that actually made Graham rich, the one that secured his legacy, it wasn't a net bargain stock found using the formulas in this book, it was Geico. In 1948, his fund put about 25% of its capital into Geico.
It was a bold move, certainly.
It wasn't just bold, it broke every single rule in his own book. The book tells you to diversify. He concentrated a quarter of the fund in one stock. The book tells you to buy cheap, unloved companies trading below liquidation value. Geico was a growth stock. It was an insurance company priced on future earnings. That one rule-breaking trade made more money than 20 years of his supposedly disciplined operations combined. In the postscript, Graham actually admits this. He asks, quote, one lucky break or one supremely shrewd decision? Can we tell them apart?
Right, he is very honest about the contradiction.
But if the author himself admits his fortune came from breaking his own rules, why on earth are we studying the rules?
Because without the rules, he
he never would have been at the table to buy Geico in the first place. You are focusing on the lottery ticket and ignoring the discipline required to buy the ticket. Graham's honesty about the Geico contradiction is exactly why the book matters. He acknowledges that journeyman efforts, the discipline, the ratios, the bond allocations, those keep you in the game. They keep you safe. Without the discipline to survive the 1930s and 40s, he would have been washed out long before 1948.
Fair point. But let's fast forward to the end of his life, because this is the smoking gun for me. In 1976, just before he died, Graham gave an interview to the Financial Analyst Journal. He said, and I quote, "I am no longer an advocate of elaborate techniques of security analysis in order to find superior value opportunities." He basically endorsed the efficient market hypothesis.
Well,
The father of security analysis told the world that security analysis wasn't worth the effort anymore. And that interview is nowhere in the standard edition of the book. Readers finish the last chapter believing Graham endorses active stock picking, when the man himself had moved on to what we would today call indexing.
I am not convinced by that line of reasoning because it completely ignores the context of his audience. Graham realized that most people simply cannot master the emotions required for active investing. That doesn't mean the principles of value are wrong. It means the implementation is hard. And this brings me to my core case. You are attacking the trades, but the book is about temperament.
Temperament is fine, but you need a strategy to apply it too. You can't just have good temperament in a vacuum.
The strategy is the definition itself. The most valuable lesson in the book is the bright line definition of investment versus speculation. Graham writes, "An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative."
It is a catchy definition.
It is more than catchy, it is a filter. Think about the era we are in right now. Meme stocks, crypto, zero-day options, AI bubbles. That definition alone is worth the price of the book. If you cannot analyze the underlying asset to promise safety of principal, like with a cryptocurrency that has a literally no cash flow, you are speculating. Graham doesn't say don't speculate. He says, if you speculate, do it with a tiny portion of your money and know that you are gambling. Most people today are gambling, but they call it investing.
I agree that the distinction is useful, but let's get into the core debate here, because my real issue is that the specific tools he gives you to find that safety of principle are entirely obsolete.
Which tools specifically are you taking issue with?
Let's start with the criteria for the defensive investor in Chapter 14. This is supposed to be the safe, easy path for the layperson. He gives us hard numbers. He says buy stocks with a PE, a price-to-earnings ratio under 15. Buy stocks with a price-to-book ratio under 1.5.
Standard value metrics.
Standard for his time. If you run those screens today in the US market, and people have, specifically Portfolio 12.3 did a comprehensive analysis on this, you get almost zero qualifying stocks, maybe 3 or 4 tiny distressed companies that are probably going bankrupt. If you followed Chapter 14 literally, you would have sat in cash for the last 15 years.
The market has certainly become more expensive, and, well, structural changes in interest rates play a huge role there.
It is not just expensive. The metrics are fundamentally broken. Research by Barrich-Lev at NYU shows that book value is statistically meaningless today. Graham lived in an industrial economy. Book value meant factories, trains, inventory, tangible assets you could actually sell. We live in an economy of intangibles. Software, patents, brand equity. Apple and Microsoft have tiny book values relative to their market cap because their value isn't in factories, it is in code and network effects. Graham's formulas would have forced you to ignore the greatest wealth-creating companies of the last 40 years because they didn't look like a 1950s railroad.
That is a valid technical criticism. The number 1.5 for price to book is dated. It was written when interest rates were 6 or 7%. But I would argue you are missing the forest for the trees here. The principle of valuation remains even if the metric shifts. The specific ratios don't matter as much as the discipline of demanding a margin of safety.
But how do you calculate that margin if the metrics are wrong? If book value is irrelevant, your denominator is essentially zero.
You adapt. Whether you calculate that margin using book value or discounted cash flow or normalized earnings power, that's just a detail. The lesson is, do not pay $1 for $1's worth of value. Try to buy it for 50 cents. If you can't find it, you don't buy.
But if you can't find anything because your model is broken, you sit in cash while the market compounds without you. That is the risk of adhering to a dogma. You call it discipline, I call it massive opportunity cost. You are advising people to use a map of 1949 Chicago to navigate 2026 Tokyo.
And I would argue that sitting in cash is better than losing 50% chasing a bubble because you threw out your standards. But let's look at the other strategy he touts, which I know you have issues with, the net.
Oh, chapter 15? This is the stock selection for the enterprising investor. The net is the ultimate Graham strategy. It means buying a stock for less than its net current asset value.
Let's define that clearly for the audience so they understand the rigor here.
Sure, you take a company's current assets, cash, inventory, and receivables. You subtract all liabilities and debt. If the stock price is lower than that final number, you buy it. Effectively, you are buying the company for less than its liquidation value. You are getting the business itself for free.
It is the ultimate rigorous value standard. It is physically hard to lose money if you buy a dollar bill for 80 cents.
It was rigorous in 1932. Today, it is operationally dead. It worked in the 30s and 40s because markets were inefficient. Information traveled by mail, and people were terrified. Today, hedge funds have algorithms that scrape SEC filings in milliseconds. High-frequency traders front-run these discrepancies instantly. If a stock is trading below its cash value today, it is not a bargain. It is a fraud, or it's a biotech company burning cash so fast it will be bankrupt by Tuesday. These are cigar butts, nasty dying companies. Research shows these stocks are mostly illiquid microcaps. You cannot build a serious portfolio on this anymore.
Okay, I will concede that the easy nets are gone. You can't just run a screener and get rich. But the logic of forensic accounting that Graham teaches in those chapters, that is more relevant than ever.
How so? If the stocks are uninvestable, why learn the accounting?
Look at chapter 17, the case studies, Penn Central, Ling Temkovat. Graham teaches you to look at a financial statement and see exactly where management is lying. He teaches you to spot pro forma earnings manipulation. He warns against companies that treat every massive loss as a non-recurring charge while treating every windfall as core earnings.
That sounds very familiar. That sounds exactly like WeWork.
Exactly. Or Enron, or the SPAC boom of 2021. The names change, but the accounting tricks are identical. Graham teaches you to read a balance sheet like a detective. Even if you never buy a net, learning how to spot a company that is lying about its earnings is a survival skill. He teaches you to look at the notes in the financial statements. That is where the bodies are buried. That skill is absolutely not obsolete.
I will grant you that financial literacy is timeless. But that brings us to the third point of contention. Who is this book actually for in 2026?
I believe it is for everyone who wants to protect their financial future.
See, I think it is actually dangerous for beginners.
Dangerous? That is a strong word for a book about conservative investing.
It is dangerous because it encourages active stock picking. It tells the reader if you work hard, you can be an enterprising investor. But Graham himself admitted later that the enterprising path is basically impossible for institutions, let alone individuals. The modern edition of the book, the one everyone buys, is 600 pages long. About 300 of those pages are Jason Zweig's commentary from 2003. Why? Because the original text is so disconnected from reality that Zweig has to step in every 10 pages and say, okay, ignore what Graham just said about railroad bonds, here's how it works now.
I think you are being uncharitable to the structure. Zweig's commentary bridges the gap, yes, but Graham's text is the foundation. The book is the ultimate shield for the defensive investor.
But the defensive investor should just buy an index fund. That is the irony here.
And Graham eventually got there. But here's the crux. To stay in an index fund when the market drops 30%, you need conviction. You need to understand why you are staying the course. This book gives you that conviction. It pushes the defensive investor toward a 50-50 stock-bond split. It champions dollar-cost averaging. It teaches them to be content with satisfactory results rather than ruining themselves chasing superior ones.
So we are reading 600 pages of complex security analysis just to be told a dollar-cost average into a 50-50 portfolio?
We are reading 600 pages to deprogram ourselves from the gambling instinct. You have to understand the default human setting is speculation. We love the action. The speculative public is incorrigible, Graham wrote. In financial terms, it cannot count beyond 3. He was funny, and he was right. The book isn't a manual on how to get rich quick. It is a manual on how not to get poor quick.
That is a compelling philosophical argument, but have you considered the opportunity cost of that mindset? If you followed Graham's defensive criteria, strictly avoiding growth, demanding dividends, demanding low PE, you missed the entire technology revolution. You missed the greatest wealth creation event in human history. Because Microsoft didn't pay a dividend in 1990, you missed Amazon because it had no earnings.
And you also missed the dot-com crash. You missed the Enron implosion. You missed the SPAC wipeout. You avoided the catastrophic losses that wipe people out entirely.
But you also missed the gains.
Graham would say, so what? If you compound at a steady, boring rate for 40 years, you end up rich. If you chase the tech boom, you might end up rich, or you might end up with 0. He is optimizing for survival, not maximization.
Let's talk about the mechanism for that survival. Mr. Market, Chapter 8.
The single most useful metaphor in financial history.
Is it just a coping mechanism?
It is a psychological tool. Graham asks you to imagine that you own a share in a business, and you have a partner named Mr. Market. Every day, Mr. Market comes to your door and names a price at which he will buy your share or sell you his. But Mr. Market has emotional problems. Some days he is euphoric and names a wildly high price. Some days he is depressed and sees only trouble, naming a wildly low price.
Right, it's a parable for volatility.
It is more than a parable. It reframes the investor's relationship with price. Most people look at the stock price as a judge. If the price goes down, they think, I made a mistake. The market knows something I don't. Graham says, no. The market is not a judge. It is a servant. The price is an offer. You can accept it or you can ignore it. That reframing, viewing volatility as an opportunity rather than a verdict, is the only thing that keeps investors from selling at the bottom.
I will give you Chapter 8. It is brilliant. But let's look at Chapter 20, Margin of Safety. Buffett calls this the bedrock.
It is the bedrock. Confronted with a challenge to distill the secret of sound investment into 3 words, we venture the motto, margin of safety.
It is a great motto. But my issue goes back to the math. Is it a calculation or a feeling? Because Graham presents it as a calculation, bond yields versus earnings yields. But in a world where intrinsic value is hard to calculate because of those intangibles we discussed, margin of safety just becomes an excuse to be a permabear. If you require a 50% discount to buy Apple, you will never own Apple.
No, it is a recognition of fallibility. That is the beauty of it. Graham knows he might be wrong. He knows the future is completely unknowable. So he says, don't buy a bridge that can hold a 10,000-pound truck if you are driving a 9,900-pound truck. Build a bridge that holds 30,000 pounds.
Yet he broke that rule with Geico. He drove a 50,000-pound truck over a small bridge, and the bridge held, and he got rich.
Or perhaps he realized that the margin of safety in Geico wasn't on the balance sheet. It was in the competitive advantage of their low-cost business model. He evolved, and the book allows you to evolve too.
I think that's a generous interpretation. I see a man who realized his strict rules were simply too limiting. But I think we are reaching this synthesis here. We both seem to agree that the methods, the formulas, the specific bond allocations, the net screens are largely obsolete. You cannot run a portfolio in 2026 using the numbers from 1972.
I would agree they require massive adaptation. You have to adjust for inflation, for the nature of the economy, and for the sheer efficiency of modern markets.
But we also agree that the psychology is immortal.
Absolutely. Mr. Market is a genius construct. It reframes the entire emotional experience of investing. And the distinction between investment and speculation is the only thing standing between a retail investor and the casino.
So for the listener trying to decide if they should slog through this 600-page tome, what is the honest takeaway here?
My honest takeaway is this. You cannot call yourself an educated investor if you haven't grappled with Chapter 8 on Mr. Market and Chapter 20 on Margin of Safety. These are the bedrock. Read them. Reread them when the market crashes. Use the rest of the book as a history lesson on how to think businesslike about stocks. It teaches you that a stock is a piece of a business, not a squiggle on a chart. It dignifies the profession.
And I would say, read it with your eyes open. Acknowledge that the father of value investing was actually a closet indexer by the end of his life. Do not try to replicate his returns using formulas that no longer work. You will get crushed by algorithms. Recognize that his biggest win came from breaking his own rules. If you read it to understand the history of financial trauma that shaped the 20th century. But don't build your portfolio today based on interest rates from 1972.
I think that is a fair warning. It is a book about character as much as capital.
Character or scar tissue.
Perhaps they are the exact same thing in this business.
A profound thought to end on. So is the psychological armor worth wading through 300 pages of obsolete math? You decide.
And just a quick mention, we have a deep dive lesson series coming up where we break down the specific concepts like nets and Mr. Market in detail, so definitely keep an eye out for that.
Thanks for being here. Subscribe, leave a comment with your take. Check the description for the book link. See you next time.